Hey guys, and welcome back to my channel, and welcome back to a very overdue financial property savings style video. You're going to have to bear with me because it has been a long time since I've done one of these videos on my channel, and I'm going to be completely honest, I've probably tried filming this intro about 10 times and I just can't get my words out. I just feel a little bit but we are here today to run through loads of different questions you have sent me in to help you guys out. Some of the questions we're going to be covering are things like self-employed and getting a mortgage, budgeting, savings, credit, buying cars, debt. I have done tons of dedicated videos on topics, so I'm going to leave the playlist down below. There are literally so many videos, like half an hour long, talking about how you can save in detail, the property buying process, loads of different things like that. But I thought it would be fun to just sit down and have like a chatty vibe as if we're on FaceTime, you've sent me in your dilemma and you want a little bit of support with it. Please send in more questions in the comments down below. If you want me to do a part 2 to this, do let me know, because obviously I want to bring you guys the content you want to see. So we're just going to dive straight on into it and crack on. Also, I really apologise if there's any backing noise. There is so much work being done down my street. It is hot, I've got a ring light on. I'm trying to sip my water to keep myself hydrated. We're sweating out here, okay? We're just trying to get through it, so I do apologise. I just wanted to bring back one of these videos on my channel and stop delaying it any longer. The first question is, if you have a sizable amount of debt, what would be your strategy to pay off these debts? So it really depends on what the debts are and also how long they're running for. So if it were me and I had a load of different debts with different companies, different values, but as a whole there was a lot to pay back, I would start by writing out a simple spreadsheet or literally on a piece of paper who the debt is with, what is the outstanding debt amount, the interest rate of the debt, and then also how long until it needs to be repaid. Then I'd start figuring out what takes priority to be repaid the quickest. So it's things like the interest rate. Obviously the higher the interest rate, the more that debt is going to be costing you each month. So debts like that I would look to repay quicker than other ones because the lower interest rate ones are not costing you as much. I would also consider things like interest-free periods. So if you have a couple of credit cards currently and you are paying interest on these, can you potentially transfer these credit cards onto a new credit card with a 0% period for however long to help you manage paying back the other debts, and then you can focus on them when the 0% interest period ends, if that makes sense. Another thing you can look to consider is debt consolidation. So there are services available where you can consolidate all of your debts into one debt and just pay back a fixed lump sum every single month. So it's definitely worth doing your research, looking into different options available, seeing if there's ways you can move the debt around to get a lower level of interest so that you're paying back less interest and more of the actual outstanding debt amount, because interest is just the amount you're being charged to have that debt. It's not actually repaying down the debt any further, which isn't helping us get anywhere. Another thing to think about too is your spare money each month. So if you do have lots of spare money that you're perhaps saving or spending, have a think about if you could commit a little bit extra each month to repay your debts down quicker, because the quicker they're gone, the quicker you have a clean slate, you can start again. However, that's not to say all debts are bad. Obviously I have my mortgage, I have got my car, I've got quite a few different 0% finance options. Everyone has their own opinion when it comes to debt and what they feel comfortable with, so it's always down to how you feel. There's no right or wrong answer. But yeah, personally if it was me, I'd be looking at the higher level of interest ones first off and working my way through them that way. The next question is, I want to achieve my goal to save 10,000 by the end of this year. Do you have any advice? So when it comes to saving, it's always important to have a goal. So it's great you've got that number in mind already. And it's literally as simple as getting your number, £10,000, and then looking at how many months you want to save that over. So in your case, you want to achieve it by the end of this year. And yeah, divide that amount by the months you have, and then you know exactly how much money you need to save each month. Then you can simply look at your current income and your current expenditure. What do you have spare each month? What are you currently saving? Is there any more money you can be saving? And this is often where people get to the point where they are saving as much as they can, their expenses are high, they physically can't save any more money, and that's where we need to look into ways to generate ourselves more income. And that could be reducing your outgoings, negotiating existing contracts and outgoings you have to try and get them down, or taking on additional income or side hustles to help us boost our income for a short period of time so that we can save quicker. I have done videos videos all about that, so I'm going to leave them down below if you want like a thorough, in-depth video on how to save and how to save fast, because I feel like that's something I'm quite good at, to be fair, and I always have been. Way before my YouTube days, I've been quite good at saving, so I'd love to help you with my tips on those topics. And also that helps out with the debt question as well, because if you're looking to pay back your debt, you can find ways of increasing your income to then clear the debt quicker too. I'm about to start my career self-employed. Is there anything I should do now for my mortgage in 2 years? So when it comes to getting a self-employed mortgage, I think it's no secret that it's quite difficult in comparison to getting an employed mortgage. When it comes to an employed mortgage, you typically just need 3 months of bank statements to prove your income, and then you're pretty much good to go within reason. When it comes to self-employed, lenders want between 2 and 3 years of books to lend you any money. So yeah, it can take a period of time being self-employed before you can actually take on a mortgage, and lenders will also consider the income you have earned across all of those years they're looking at. So if you start off on a lower amount year 1, and then you grow year 2, and then you grow year 3, they will often add either the 2 years or 3 years of books together and then divide by that number of years to get an average of your earnings, which is quite unfortunate, because when a self-employed person starts out, often their income is lower in the earlier years and then it goes up, but you can often be penalised for the lower income years you had at outset. So it can be tricky, I'm not going to lie to you. If you are looking to be able to borrow as much as you possibly can to get a mortgage, then you of course want to have as high books as possible, and ways you can do that is to not put through as many expenses, which is difficult and annoying because ultimately there are overheads to running your own business. But if you put them through as an expense, effectively they come off your profits and then reduce your income for the purpose of borrowing. So you can go down that route of not putting any expenses through, or lowering your expenses massively, boosting the income level on paper, but then you're paying more tax in the process, meaning you can't save as much during those years. So it really is a case of what you're comfortable doing, what you're looking to achieve, and a mortgage advisor can help you out a little bit more in detail on that topic. But hopefully that gives you like an initial starting point of what you can start thinking about. Someone has said, I've saved for a car now, but I don't want to spend it, but I need a car. What should I do? Okay, so that's a little bit of a situation where you need a car, you've got the money, but you don't want to part with the money. I completely get it. The other options you can go down is either finance a car, you could lease a car, so you're paying out a sum of money every single month, but you're not actually parting with your savings. That's something to consider, because although you have the money there, it obviously takes longer to save a big lump sum than it does to just pay out a couple of £100 a month on a car. But then you need to consider the fact that interest rates are quite high at the minute, so the total amount you're paying for the car is going to be considerably more than if you just bought a car outright, and you just need to decide if you're comfortable with that. Personally, for me, I've always historically been happy paying interest for a car, because I would rather pay out say £300 a month and have the car I want than part with £20,000 lump sum, because you know it's going to take me a damn sight longer to save 20,000 with 300 a month than it is parting with 300 a month. So I'd rather do it that way, but that's just my own like method behind the madness with what I do. Another thing you could think about as well is getting a cheaper car. So maybe do buy a car with the money you've saved, but just get something that's a little bit more budget friendly, or you could put a deposit down on a finance car and do it that way to keep the monthly costs down, but just parting with a little bit of your savings and not all of them. So hopefully that gives you some ideas that you can use. How's best to split bills when living with a partner? Again, there is no right or wrong way. There are a couple different options you have when it comes to splitting your bills. The first method is just a straight 50-50. So it doesn't matter who earns what, you just both pay half of the bills, because ultimately you're both benefiting equally from that property. So paying half the bills each does make sense. Another option is to do it as a percentage of your earnings. So if one person earns a lot more than the other person, you basically split the bills according to income. So what you would do is you would add your two incomes together. So let's say one person earned 30,000 a year, but then the other person earned 60,000 a year. Together, your income is 90. And then what you would do is you'd work out the 30,000 as a percentage of 90, and then the 60,000 as a percentage of 90. That makes sense. And then you basically split the bills in accordance with that. So effectively, you're losing the same in correlation to your salary, if that makes sense. I mean, it's a hard one, because ultimately, if someone doesn't earn as much money, perhaps they're going to struggle to afford what you're aiming to buy or move into or rent. but at the same time, should someone be penalised for earning more money because potentially they're doing more hours? That is really your call in a relationship to decide what you are comfortable doing and what's going to make you happier. If you're buying a house, you can own the house on different percentages. You can own the house jointly, but you can also split the percentages. It doesn't have to be 50-50. It can be, say, 30-70 or 60-40. So it could be something like that you consider, where you own the house on a percentage basis and not jointly, in accordance with who is paying for what. So yeah, there's no right or wrong answer. Just have a sit down and have a conversation with your partner. But I think it's so important to have these discussions before going in and buying a property, to make sure both people are comfortable, both people can afford it, and ultimately you're in agreement. Because if you can't be in agreement about something as basic as who's paying the bills, you're probably gonna have quite a hard time living together. The next question is now a bad time to buy a house? I've saved the past 2 years with rates going up. So it really is a crystal ball situation when it comes to buying a property. When is the right time? I don't think there is truly ever a right or a wrong time to buy a house, because it really is just a crystal ball. Things are constantly changing. You're never going to have the same situation as someone else. Everything is always going to be up and down. Interest rates are constantly going to change. The demand and the supply of property is always going to be changing. The price of houses and how much you can buy and you can sell for. So there's never going to be the same day when it comes to buying a house, if that makes sense. And I guess you just have to kind of look at your current circumstances in their form as they are now, and if it's affordable to you or not. So of course right now interest rates are through the roof. The Bank of England base rate I think is sitting at 5% now, which is extremely high compared to when I first bought a property. I think when I got my first place it was 0.5%, so things have gone up drastically. My first mortgage was 1.65%. My mortgage on this house is 2.15%, and I've just remortgaged my rental property at nearly 6%. So it just shows you how much things have gone up, which drastically increases the monthly payments. To give you a little bit of context, my rental property mortgage was $500 a month. It is now nearly $800 a month. So it's gone up a lot, and it really is a case of if it's affordable to you or not. You could sit and wait, but the problem you have with sitting and waiting is if property prices keep going up, even if interest rates come down, you might be paying more for the property. Even though rates come down a little bit, the monthly payment may still be the same. Rates could keep going up too, so you could sit and wait another year, and then rates might go up again by another 1%, so you might not be in any better position by waiting. You may wait and rates could come right down, and then you might kick yourself for committing to a property at a higher value or a higher interest rate. I really apologise for that noise, but we're just going to keep filming. So it's one of those situations you're never going to know truly if now is the right time. I think it's really just down to if you can afford it ultimately, because you could potentially fix your mortgage for 2 years, 5 years, whatever you feel comfortable with. My mortgage advisor recommended that I just fix for 2 years, so a shorter time, because he felt that interest rates will hopefully come down in that period, so that a worst case scenario, I'm paying a little bit more on my rental property for just 2 years, and then if rates come down we can lock in at a lower rate in 2 years. So that's something you can think about doing. So yeah, it really is just down to if you can afford the monthly payments or not, and if you are comfortable with that. You're never going to get the same day again when it comes to houses. Things will always go up, always come down, and you're never going to truly know the answer. So sorry for not giving you a yes or a no answer. It's just difficult. It's just difficult. That is the bottom line. How to maximize savings. When it comes to saving money, there are a couple different ways you can go about doing things. You can either just save your money in cash, or you can invest your money. When it comes to saving your money in cash, you can leave it in an instant access account, meaning you can take the money in and out instantly. There is no penalty or no fixed period. And then the other types of savings accounts are notice accounts or fixed term accounts, and that's basically where you lock your money in for a fixed period of time, or you have to provide notice to access the money. The interest rate available on those kind of accounts is going to be higher because you have to give notice or you have to wait to access the money. So it depends on if you need access to the money or not. I personally think it's really important to have an emergency fund, because you need a pot of money sitting there if something goes wrong, if something happens to your car, or if your boiler blows up or something like that. You always need a pot of money aside for your emergency emergency funds. So once you have that set aside and you can access that instantly, I then think it's important to look at the rest of the money and what are you saving for. If you're saving for a house and you know you're not going to be buying one for a couple of years, maybe you should consider the fixed accounts or the notice period accounts and benefit from a higher level of interest. When it comes to financial advice, because obviously I've worked in financial advice for 11 years, I'm currently on a little bit of a career break, but that is what my career was for 11 years. We always said to clients, if it's the short term, which means less than 5 years, then investing money is not a sensible idea. If you're looking to access the money past the short term, i.e. longer than 5 years, then you can consider investing your money. So yeah, if you're investing into the stock market, really you should be able to hold the money for at least 5 years, because it may have up and down periods. The stock market is a lot more volatile and risky, of course, whereas a cash investment is secure as long as you're investing into something regulated and potentially a high street bank. So you've got your different options to consider. Typically your pension funds, they're going to be invested in the stock market or in bonds or in property. They're going to be invested into basically a mixture of different things. And if you're saving for something in the longer term, then you could consider investing the money too. But if it's just a short-term saving plan, then your best bet is probably going to be cash. I just want to caveat here as well, guys, even though I have worked in finance, this video is not giving you personal advice. I'm just giving you guidance and information based on my understanding of things and my personal view. But if you are looking to take action, then you really should seek professional advice from a financial advisor or a tax specialist if you're looking to invest money into something, because I do get quite a few questions on what should I invest my money into, what stocks would you recommend, what funds would you recommend. That is just not something I'm allowed to do, and it wouldn't be appropriate of me to do that even if I was able to, because ultimately a recommendation is so personal to the individual, depending on how they feel about things, their circumstances, how much money they've got, the risks they want to take, the risk they can afford to take. So when it comes to real specifics like that, definitely go and seek advice from a professional. But hopefully what I say just gives you a little bit of guidance and helps you along your way. But yeah, please do not take any action off the back of what I am suggesting, because these are just my own personal thoughts and feelings on these topics. Tips on buying a first house solo, and then I've had lots of other questions about how to buy a house now, how to buy a house by yourself, because things are difficult. Obviously, as we're all aware, properties are through the roof. I don't think I've ever known properties to be so high. None of us have. They've just gone up and up and up. We all thought they would drop. They haven't dropped, they just keep going up and up and up, you know. Salaries are definitely not increasing as quickly as property values are. But yeah, I think it is quite obvious that now is probably like the hardest time ever to buy a house. But that's not to say you need to be disheartened. You can still work towards buying a property. A real simple way of working out what you can afford is getting your salary. So let's say you earn 35,000 a year. Get your salary, pop it into your calculator on your phone, and then times that by 4.5, and that will tell you how much roughly you can borrow. The borrowing capacity now is between 4.5 and 5.5 times your salary. So I'm obviously being a bit more cautious with going with the 4.5, but yeah, if you earn 35,000 a year, the rough amount you can borrow is this amount here, so 157,500. Mortgage lenders will also consider existing debts you have. So if you're paying out for, say, a phone contract or a car finance or a loan debts, they are going to impact how much you can borrow. They will reduce the amount you can borrow. So it is a good idea to try and get any debts down as much as possible before you're looking to get a mortgage, because like I say, that is going to impact you. So I think, yeah, if you're looking to buy a house solo, the first starting point is to look at your salary and think, well, what can I actually borrow based on my current salary? Okay, I know I can borrow this amount right here, and then go online and have a look at properties and see if there's anything at all within that price range. In all honesty, if you're in Essex or anywhere near London or anything like that, this is not going to get you anything, which is, like I say, very disheartening to hear. Maybe up north it might help you, and that's where government schemes come into play. So when I first got my first property, I was earning around 40,000 a year, and even earning that salary, which I think is considered like a fairly good salary to be honest, I still couldn't afford to get a property in Essex because it just wasn't enough. So I had to use the Help to Buy equity loan, which I personally really liked. I have done a video all about it. I know the schemes have changed now. My knowledge is not completely up to speed on them, so I wouldn't want to comment too much without looking into them. But there are government schemes available, like whatever the equivalent of the Help to Buy equity loan is these days. There's also shared ownership options available too. And whilst of course these are not the preferred options, you don't necessarily want to have the government tied into the contract. If that's all you can do and that's going to get you on the property ladder, then it's something to think about. And that's how I viewed it when I got my flat. I thought to myself, yeah, it's not ideal. I've got this government loan. I'm going to have to repay it back, because if I don't, I'm going to be charged interest on that loan, which was much higher than normal interest rates at the time. So I definitely wanted a plan to pay that back, which I set in place and I did achieve. So I think that's really important. If you are going down that route, make sure you do have a plan that you can pay that money back in the future, you know, working out how much you need to save for a period of time to pay that back. But there's also other options, like when it gets to the end of the term, you can sell the property and you can pay it back with property proceeds. You're probably going to be moving by the end of the term anyway. So try and not let it be the overruling factor in deciding. It all comes down to affordability at the end of the day. And if you can afford the monthly payments on the mortgage, or the mortgage and the rent, if you're going down the shared ownership route, then it's something to think about. It is something to think about, and it's not ideal, but ultimately it's the world we're living in. And I don't really feel like things are going to be changing anytime soon. And ultimately, being able to get on the property ladder in any shape or form, if that's buying a property with a 5% deposit, if that's buying a property with a 20% deposit, if that's having a 25% ownership in something or 100% ownership in something, it's an achievement. Like, you have worked hard and you are buying a part of a property. So try not let it get you down and disheartened. And also think about as well, the monthly outgoing when you're buying a property is normally less than what rent costs. Even with the increased interest rates, from what I have seen, it's still cheaper than what you would pay in rent. So you have to weigh up these options as well. When being self-employed, how many years of bookkeeping do you need for a mortgage? And is it the end of the tax year the 2 years counts? So as I stated earlier, it's normally 2 to 3 years of books that you need depending on the lender. And yes, you have to complete that tax year and you have to submit your tax return. So the tax year runs from the 6th of April till the following 5th of April, and then you can submit your tax return straight away. Most people wait until January the following year, which is basically the deadline, but you can submit your tax return straight after the end of the tax year, have your full completed year book, and then once you have 2 to 3 years of books, you can start looking into getting a mortgage. And a mortgage advisor is your best bet when it comes to self-employed work. Mortgage advisors can work their magic. They have relationships with a lot of the lenders, they can have discussions with them, and they can package up your file to be a lot more favourable often than when you go direct yourself. Finding a balance between saving and also spending. I feel like this is a real situation we've all been in. I've definitely been at opposite ends of the scale when I've just been spending everything, and then other times where I've been saving everything. And saving can become quite addictive. When you start seeing the money rack up, you often just don't want to spend, and then you just become a saveaholic, which is great in the short term, but then also you're not enjoying your life too. So I think it's important to have the balance. I definitely do. And something I used to do when I was really saving hard, when I was saving hard for my first property, and I really had a goal and I really wanted to achieve that goal because it was so important to me. It was more important to me than going out of an evening and going out for fancy meals and stuff like that. I would still set myself a budget each month of allocated spending money. I personally gave myself £200 a month, which at the time was about 10% of my income after tax. So, you know, I was saving a massive chunk of my income, but I was still living my life. £200 a month is still a good amount of money to do things. You can still go out for quite a few meals on £200. Like, think how many Nando's you can have on £200. You can still budget for holidays. You could save £100 a month for 6 months and you've still got enough money for a holiday. You can still save for things, you can still budget for things, but ultimately it really gave me discipline to save a majority of my income. So that was a really good amount for me actually, to just about manage to keep up my social life and still have have fun and enjoy my 20s whilst still saving a really nice amount of money. But another way you can do it is splitting it. So after your expenses, whatever money you have left each month, you could save half, spend half. You could save 70%, spend 30%, whatever works for you, depending on what you're saving for. If you've got a really big savings goal, then obviously you're going to want to save quicker. But if you're just saving day to day because you want to build savings and you've got no actual massive goal and focus, then you can be a little bit more lenient with it. The next one is, I really want to buy an investment flat. Do you have any tips or things to be aware of? So things are changing when it comes to buy-to-let properties, and not for the better, let me just tell you that. So the rules that they used to have was that you had to earn £25,000 a year, and then you could basically get your buy-to-let mortgage, and it was a 25% deposit of the property value. Now they do something called stress testing, so you don't always have to actually have a salary anymore to be able to get the mortgage, which is good, because if you're self-employed, you could potentially still get a buy-to-let mortgage quicker than you could get your normal mortgage. So you can still get on the property ladder and have a property growing. Does that make sense? But things have changed. So with the stress testing, they basically look at the rental income the property is expected to generate, and then they use this to work out how much they're willing to lend you. So the 25% deposit option has kind of been scrapped in a way, and it's down to this stress testing method where they'll work out how much money they're willing to lend you on that property. They'll also factor in any estate agent fees or overheads on the property as well. So if it's a flat, you'll have ground rent, service charge, and these will all impact how much money they're willing to lend you, and this will basically determine the deposit. To give you an example, I found a really lovely flat for £300,000 the other day, and I thought, wow, this would be an amazing investment property. It was just beautiful. Now, based on a few years ago, all I would have needed is around, I would have needed around a £75,000 deposit, about 25% of the property value, and £25,000 a year income, and then I could have got the property. I basically popped in the property value, what the rental income was expected to be, and the overheads, and the bank came back and said they would only lend £172,000 on that property, making the required deposit around £130,000, which is way more than the 25%. So it's becoming increasingly harder to now get a mortgage on buy-to-let properties. Another thing as well now is the things that you can put through as expenses has massively reduced over the years. So they basically scrapped a majority of things you can put through as an expense. So to give you an example of my situation, I kept my first apartment, and over the years what I can put through as an expense has reduced so much it costs me money each month to keep that flat. So the rental income that I'm being paid on that property should be enough to cover the mortgage, the estate agent fees, the ground rent, the service charge, and have a bit of spare each month. But because of how the tax is now calculated, it costs me each money. So not only am I making no income from it, it's actually costing me money out of my own pocket just to keep that property. And this is being done because effectively they don't want people to have as many rental properties, and they want to free up properties for first time buyers and stuff like that, which I guess it does make sense, but it's making it increasingly harder for a property investor. You can buy properties through a limited company, and the tax benefits of this are better in the sense that there is more things you can put through as an expense. You have more options in terms of how you draw the income. You pay corporation tax on it. So yeah, there's different options to consider. So yeah, in that situation, you can just do a simple calculation online like I did, just to see if there's any possibility or not. And if the figures are looking like maybe there is possibility, then your best bet is to go straight to a mortgage advisor and work with them on calculating how much you can borrow and getting the application underway. And then also speaking with a tax specialist who can look into the company route versus holding it personally to figure out what works best for you on a tax perspective. The last question we're going to answer, because seriously I'm getting so frustrated by this noise outside, and I'm just so worried you guys are going to get annoyed by it too. Someone has said, what would you say to your 18-year-old self to do differently regarding your finances? So if you've been here since I was young, you'll know what I've done within reason, but the only thing I would change is how many cars I bought. In fact, that's a lie. I wouldn't change anything, because everything I've done has got me to where I am now, and I'm really happy with where I'm at and the journey I went through to get here. But the one thing I probably would have done differently is how many cars I bought. I was just car mad, and I would literally trade in my car after like 3 months, 6 months. I would never keep a car more than 6 to 9 months. I think I literally went through 5 or 6 cars in the space of like 3 years. I'm not even joking. I was ridiculous. It was just the thing I just chopped and changed like hair. Like, as you know how quick people change their hair colour and extensions, that's what I was like with cars. It was just crazy, and I wasted a hell of a lot of money doing that. I would dread to think how much money I truly wasted. I'm not joking. We're talking so much, like probably 10,000-20,000 at least. Yeah, I feel like I wasted a lot of my salary back then on cars and just trying to get a new car all the time and being indecisive and just being too impulsive, buying something, not really thinking about it. That's the only thing I'd change, I think. Other than that, I'm really happy with my savings journey and how I got to where I'm at now, and the ups and downs I've had along the journey and all of that too. And I really don't think I'd have it any other way, to be honest with you. I think I'll wrap the video up here. I really hope you guys have found this helpful and it's given you some ideas and things to think about, and I'd really love to do another one of these if you enjoy it. So I really would love your feedback in the comments down below. Let me know if you enjoyed this video, what other questions you have that you would like me to comment on, and what other sort of videos like this you would want to see, because ultimately these have been created to help you guys out, so I want them to be as helpful as they possibly can be. So thank you guys so much for watching, and I really look forward to seeing you soon. Bye.